Greetings and hope this finds you well. Welcome to lesson number 3. So previously we discussed the categories of currency pairs, the trading sessions, and the volatility of currency pairs. So today I want us to cover these or discuss these three objectives. One, what is a pip and a stop and a lot size. Number 2, what is long and short position. Number 3, what is bid price, ask price, and the spread. Yeah. So, what is a pip? A pip is a short form for the term percentage in price, and it measures the price movement of a currency. So, therefore, a pip is the price difference. Let me give you an example of this pair here, and I've indicated the chart. Let's say, for instance, in a certain day, this pair moved from this price, that is 35.92 to 36.00. I'll say pip is the price difference, or rather is a measurement of price movement of a currency. So if the price moved from 35.92 to 36.00, the price difference, you're going to get it from subtracting 35.92 from 36.00, and we get 8. So 8 is the price difference, and therefore the pip. And I hope that is clear. So let's get to what is a lot size. The lot size is the value per pip. So the lot size determines the value per pip of your trade. And we have three types of major lot sizes. One, a standard lot, a mini lot, and a micro lot. And one standard lot represents 1,000 units of that pair, and a mini lot represents 10,000 units of that currency pair. In the same case to a micro lot, which represents 1,000 units of that pair. So for you to understand this concept of lot sizes, let's create a scenario. We have three traders, that is trader 1, trader 2, and trader 3. They are all trading the same pair, that is Euro USD. And in this case, this pair moves by 1 pip. Trader 1 is using a standard lot size, trader 2 is using a mini lot size, and trader 3 is using a micro lot size. So what is the return, either as a profit or as a loss, after this pip movement? Trader 1, who used the standard lot size, is going to get $10 as a profit or as a loss. Trader 2, who used the mini lot size, is going to get $1 as the profit or the loss, or a loss. Trader 3, who used a mini lot size, is going to get $0.10, either as a loss or a profit after the same pip movement. Question number 2. What is long and short position? So short position means that you are selling the currency pair, meaning that you are anticipating that the quote currency will get stronger than the base currency. Hope you remember what we said is the base and the quote currency. The base is the first currency in the pair, and the quote currency is the last currency in that pair. So when you're selling, or when you're in a short position, you are anticipating that the quote currency will get stronger than the base currency. For instance, if you have Euro USD and you are selling or in a short position, anticipating that the US dollar is going to get stronger than the euro. Okay, so simply short position means you're buying high and selling low, as I've indicated here. So if for instance the current price is here, the current price is at that point. If it is a Euro USD currency, and I know, and I've done my analysis, and I've known that the US dollar is going to get stronger over the euro, I'm going to enter here, that is buy high, and sell what? Sell low. That is basically what you call a short position, buying high and selling low. I hope that's simple and self-explanatory. Now, conversely, the long position is just the opposite of the short position. Now here, you are anticipating that the base currency is going to get stronger than the quote currency. So what do? You buy low and sell high. So that is as simple as that. The last question, what is a bid price, ask price, and the spread? So this is a concept that is mostly used in simple market structures and often on auctions. And let's say, for instance, let's create a scenario. I go to the market and I want to buy a mango. And the price, or the seller has tagged the price of one mango at 50 Kenya shillings. And I'm willing to pay for that one mango at Kenya shillings. So the 50 Kenya shillings becomes the ask price, which is the price the seller is asking for one mango. And the 30 shillings becomes the bid price, which is the price the buyer, that is me, that I'm willing to pay for one mango. Now the difference, which is 20 shillings, becomes the spread. And mostly this is this is how brokers make money. Same case here. Your broker has a price he or she is willing to sell a currency pair, and the price you, as a trader, you want to buy that currency. So if you agree, the ask price is usually higher than the bid price, and the spread is how your broker makes money. To be able to provide the services he or she offers to you. So let me give you an example of that. In this case, as you can see, we have this currency pair, that is XAU USD, also known as gold. The bid price as at now, or the time we extracted this image, that was 35.79.42. That is the bid price. The ask price was 35.79.59. So the difference, which you can see here, which is indicated here, that is 17, becomes the spread. So a quick recap of what we have done. One, we have defined what is a pip and a lot size. We have said a pip is basically the price movement or the price difference. The lot size is the determinant of the value per pip, meaning the lot size you use is going to determine the price or the value you get from those pip movements or those price difference. Second, we defined, or we expounded on the short and the long positions. We said the short positions, you are basically selling the currency pair, meaning you are anticipating that the quote currency will get stronger than the base currency. Conversely, we have the long position, which is you're buying the currency pair when you're anticipating that the base currency is going to get stronger than the quote currency. Lastly, we have discussed the ask price and the bid price and the spread. We said the ask price is the price the broker is willing to sell a currency pair to you. And conversely, to the bid price is the price the broker is willing to buy currency pair from you. So that's the difference. The ask price is to you and the bid price is from you. And the difference is the spread. So I hope that's clear, and if there is any question, let me know. And next, we are going to look at the metrics, the features and the matrices of MT5, and I hope that is going to be well. Thank you.